These guys are networks. They're not like brokers get on the phone like buy, sell. They go and have a steak dinner with their best client who talks about this Bitcoin ETF. They're like, I'm not sure. They read Barron's that week. They're like, I'm not sure if it's the right thing to do. They then go and play golf. Their other client talks about it. And eventually, this huge property developer from Cincinnati then sticks in, $5 million into the ETF. This is the process. So it's actually really slow. And we've only just started. And a lot of these people are driven by price. If you look at NVIDIA, you see how price feeds on itself. It becomes reflexive. So we've just started. These RIA networks generally talk to their clients about, you should think about an X% allocation. They put an X% allocation, or they mandate it and say, hey, we're going to do this for you guys. They do it. And then what happens is, Dan and I have seen this all the way through with friends of ours. They start with 1%. And then before you know it, they get up to 5%. And they're like, it, we're going to 10%. Because they start to understand the power of this thing. So it becomes very reflexive in price action. I've seen family offices. I've got one of the investors in my fund is a big Australian family office. At first, their allocation was 1%. I think...
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
They probably got up to 20% in crypto allocations in the end, because, once the principals started to understand it, that it just keeps building on itself, and the price action just builds on it. So we've, as Dan said, we're really, really early still. And then there's also these massive platform models like BlackRock, Fidelity, Morgan Stanley, JP Morgan, that suddenly add it to their asset allocation mix. And those guys control like $1 trillion of assets. So once they do it, it's the same process. It then starts dollar cost averaging in. And, we've seen BlackRock talking about doing that. I don't think it's even started yet. So those massive pools of capital start coming in as well. And we're not talking institutions. None of the institutions are in yet, really. Also, don't forget, the 401k bid in America is another big thing. One of the reasons passive funds have outperformed active portfolios, like the NASDAQ and the S&P, keeps outperforming, is because millennials, every 2 weeks, add to their 401k of this stuff. They can now add Bitcoin into their 401ks. So that becomes a every 2-week bid that goes in perpetuity forever. Now, it doesn't mean it can't go up and down, with the business cycle, but it's a very big structural change that people don't really understand.
In recent times, there has been a notable trend in the financial landscape, marked by a significant institutional involvement in cryptocurrencies. This involvement signals a crucial development in the perception and integration of digital assets within traditional investment portfolios. One prominent example of this institutional embrace is evident in the actions of major financial platforms such as BlackRock. These institutions have been gradually incorporating cryptocurrencies into their asset mix. This strategic shift reflects a growing recognition of the potential value and significance of digital currencies within the broader financial ecosystem. Furthermore, the inclusion of Bitcoin in 401k plans underscores a structural shift in investment behavior. Historically, retirement accounts like 401 Burmese Kyats have predominantly focused on traditional asset classes such as stocks and bonds. However, the incorporation of Bitcoin into these retirement plans signifies a departure from conventional investment paradigms. This shift is not merely a fleeting trend, but rather a reflection of the increasing price reflexivity of cryptocurrencies. As institutional players enter the market, their actions and investments contribute to a feedback loop that influences the valuation of digital assets. This phenomenon further validates the legitimacy and potential long-term viability of cryptocurrencies as an asset class.
You've got to understand that a 5% interest rate is not a hurdle to an asset that goes up 100% a year on average, right? It's irrelevant. But liquidity drives assets. So liquidity did pick up, but as Dan's rightly said, the game is only just started in the liquidity cycle. At the end of this, the Chinese are in the middle of pretty much a debt deflation. They're going to print money, serious amounts of it. The Fed are going to cut, the Europeans are going to cut, the Fed are probably going to end up bailing out a few banks. The whole game is to be played. We've got an election to bribe voters with. There's usually straight after the election, there's usually a fiscal stimulus. Let's say Trump gets in, he'll probably do a stimulus. There is money to be handed out all over the place. So what is surprising is, yeah, we had a very strong run even before the halving. It's early in the macro season.
In the crypto world, the behavior of what are known as whales holds significant sway over market expectations. These whales, typically referring to individuals or entities holding substantial amounts of Bitcoin, often serve as barometers for market sentiment and future price movements. When Bitcoin whales maintain a steady position, it's often interpreted as a sign of anticipation for price appreciation. Their confidence in holding onto their assets suggests a belief in the potential for Bitcoin's value to increase over time. Understanding market dynamics in the cryptocurrency realm involves grasping the concept of liquidity and its profound impact. Liquidity is a driving force in financial markets. In the context of Bitcoin, liquidity plays a crucial role in determining market shifts and volatility. Moreover, Bitcoin's price is subject to a myriad of factors, both internal and external. Global economic conditions, geopolitical events, regulatory developments, and technological advancements all contribute to the complex tapestry of Bitcoin's market dynamics. These factors can trigger fluctuations in Bitcoin's price, influencing the behavior of whales and the broader market alike.
But it is what it is. Does it mean that we're going to have a really big run this cycle? I don't know yet. Cycle to me is driven by the macro. That macro cycle has been the 3.5-year, 4-year cycle, and it's the same cycle in all assets. So I don't see any reason the cycle would change unless we create some sort of weird monster bubble in crypto, or we just got a very strong cycle on our hands. Some cycles are stronger than others. And the last cycle, I thought cut short. I thought there should have been a next leg higher. I thought it should have got to 100, and it didn't. And I think people have PTSD from that. And so I think they're fearful of screwing it up again and getting too bullish. And I actually think there's actually more of a fear of something like 2013, where it kind of had a dip. Everyone thinks it's over, and then it went up like another 4x, something stupid. I think that the bubble cycle's actually maybe a higher probability now than this left translation. When I talk to people about the left translated, when you ask them, it's just PTSD. From the everything code work that I've done, that I've talked extensively about, it should be, normally, it's right towards the very end of 2025. Now, could it be a little bit earlier, but normally the crypto cycle ends in November, December, every time. If you just step away and say, it's a slightly more aggressive start than we've had, why? Because we got an aggressively more amount of capital has access to the space. So it kind of makes sense. At a very top level, more people have access to it, goes up more. Fine. Step back. I mean, I even started in this crypto journey back in 2012, 13, because of this whole process. It happened in Europe, and it's been a rolling process. An excess leverage society will end up destroying all of its banks. So this has been an ongoing thing. So it's not going to stop until they all disappear and you end up with some sort of nationalized banking system. Half the European banks are still insolvent, technically. They're just being propped up by the ECB because you can't lose Deutsche Bank because it's the largest bank in Germany.
Understanding market cycles is crucial for any investor navigating the volatile terrain of cryptocurrencies. One significant concern looming over the crypto space is the specter of a repetition of the 2013 bubble cycle. This fear stems from the newfound access to capital, which has accelerated the market's growth and raised apprehensions about a potential bubble burst. There's a prevailing sentiment among market participants that crypto cycles tend to culminate around November or December. This timing is not merely coincidental but rather influenced by a collective trauma ingrained in the investor psyche from past market tumults. This psychological phenomenon, akin to post-traumatic stress disorder, often shapes investor behavior and market dynamics, leading to cyclical patterns. In parallel, the spotlight is also on the European banking sector, which faces persistent challenges. The ongoing issues with European banks raise concerns about the stability of the banking system and provoke discussions about potential outcomes. As investors navigate these multifaceted market dynamics, understanding the interplay between psychological factors, historical patterns, and systemic vulnerabilities becomes imperative for informed decision-making.